If you've been waiting and waiting to buy a home because mortgage rates feel too high, then this episode is for you. Here's the truth that nobody in the media is telling you. Today's current rates of around 6.5% as of June 2026 are actually below the 50-year average. Yep, that's right. The long-run average 30-year mortgage rate since Freddie Mac began tracking it in 1971 is 7.74%, and we are below that right now. The reason 6.5% feels high is because we all got anchored to 2020 when rates hit an all-time record low of 2.65% during a global emergency. In fact, that's just the average. Many people actually have rates locked in at even less. That was never intended to be the norm moving forward. Hello. I'm Scott. I'm a licensed mortgage broker, and today on Mortgage Story, we're covering everything you need to know about mortgage rates, what drives them, the real math on waiting, rate lock strategies, how to buy your rate down, and when refinancing makes sense. My name is Scott Stavis, and I've been a mortgage broker and property investor for over 20 years. One thing you'll notice about me is that I'm very solution focused. Every client, property, and situation is different, and my job is to find the smartest and most efficient path to get you where you want to go. I also try to keep things simple and free of unnecessary jargon. This industry can get complicated fast, and my goal is to break it down in a way that makes sense so you can make confident, informed decisions. To learn more about me, subscribe to this channel and follow along. My full bio is in the first episode. Now let's get back to our topic for today. All right, to begin, let me put today's interest rates in real context, starting with the historical chart on the left. In 1981, the 30-year rate hit 18.625%. Yes, people bought homes at 18%. They had to. Life didn't stop. Through the 1990s, however, rates hovered around 8 to 10%. And even as late as the year 2000, average rates were still lingering above 8%. The 3.75 rates that people were locking in after the 2008 financial crisis was considered shockingly low at the time. And it wasn't until around 2021 when the pandemic drove rates into the mid-twos, the lowest ever recorded in American history. And that's the number that broke everyone's reference point. 2.5 years of record low rates trained an entire generation of buyers to expect something that had never existed before. The 50-year average is 7.74%, and today's 6.5% is below that average. Now moving over to the right side of the screen, when I hear people say, "I'm waiting for rates to go back to 3%, I feel the need to gently reframe that. Rates were 3% at that time because the global economy nearly collapsed. In reality, the prior 40 years averaged above 7%, just about double that number. Now here's the strategy that works, the one that every generation of American homebuyers before us has used. Acquire the house today and refinance the rate when it makes sense to. You can't control interest rates, but you can control your refinance timing. So the smart move is to buy the home you want now at today's price. Refinance when rates drop. This is not advice that any financial expert has recently invented. It's what has worked consistently for homebuyers over the course of 50 years. When talking about rates, there are two main perspectives that drive your mortgage rate. The macro, which you cannot control, and the micro, which you largely can control. On the macro side, mortgage rates primarily follow the 10-year Treasury yield, not the Fed rate, which is the most common misconception that I hear from almost every homebuyer. Mortgage rates more closely follow Treasury bonds. When investors are nervous, they buy bonds, yields fall, and mortgage rates tend to follow that lead. Inflation pushes rates up, on the other hand, because lenders need to preserve their return over a 30-year financing commitment. And your loan itself is likely going to be bundled into a mortgage-backed security and sold on the secondary market. When investor demand for MBS is high, lenders can offer lower rates. In case economics are not your strong point, the one large piece to take home out of this section is to know that mortgage rates are more connected to Wall Street than most homeowners realize. Now let's take a look at what I have in the right column, the factors that determine your specific rate. Your credit score is the single biggest lever that you can personally control. Every 20-point increment in credit score puts you in a different interest rate tier. A 620 versus a 720 on the same loan can mean $150 to $200 or more per month in payment difference on average. Your down payment and loan type also matter, and for what it's worth, VA and USDA loans often have the lowest rates out there. All right, wake up and pay attention to this if you dozed off during the last slide. Let's take a look at the math that most buyers waiting on the sidelines have never actually run. Because I think when you see this, it changes the conversation and your mindset a bit. Here's the scenario that I drafted up for us to go over. Let's say you decide to wait 2 years for rates to drop. And they do, from 6.5% today down to 6.0%. That is a realistic, achievable rate improvement that buyers might reasonably see over 2 years. The one massive caveat to that theory of cheaper money, however, is that home prices in a rate drop environment typically rise, historically around 8% per year. Lower rates bring more buyers into the market, which drives up demand for homes. In our on-screen example, I used 5% price appreciation, which is actually conservative compared to what we saw in 2020 and 2021, when home prices rose 15 to 20% per year. First, I want you to have a look at the Buy Today column, the green box on the left. If you buy today $350,000 at 6.5%, your monthly principal and interest payment would be $2,212. Now, have a look at the red box to the right of it, the Wait 2 years column. If you wait 2 years and that scenario plays out, the same home now costs $385,875. Yeah, your rate would be lower at 6.0%, but look at the monthly payment. It comes out to $2,313. That is still $101 per month more than if you had bought that same house today. Even with a lower rate, the higher home price wipes out the savings. The price increase absorbed the rate savings and then some. And then there's your monthly rent, which we haven't even talked about yet. So have a look at the bottom of the page. 2 years of waiting at $1,800 rent per month is $43,200 paid to your landlord. That money is gone and you've built zero equity, zero appreciation has been captured, zero tax benefits, and zero personal wealth has been accumulated. The math on waiting is almost never what people expect when they actually break down legitimate figures. Now let's get into some interest rate strategy and follow along from left to right on this slide. Once you're under contract to buy a home, one of the most important decisions you'll make is when to lock your interest rate. A rate lock is your lender's written guarantee that your rate will not change between now and your closing date, regardless of what the market does. You should start to consider locking in as soon as you're under contract. I would not recommend trying to get too cute and timing the market in hopes of a slightly better rate. Rates can move 0.25% in a single morning based on an economic data release such as the CPI, the jobs report, or even a simple statement from the Fed. The risk of rates rising almost always outweighs the potential gain from waiting. When it comes to your lock length, a 45-day lock covers most standard purchase transactions comfortably. Longer locks cost slightly more, however, so if you're buying new construction, ask specifically about extended lock options. One option worth asking your broker about is the float down provision. If rates drop by a set amount during your lock period, some lenders let you capture the lower rate for a fee. In a volatile rate environment, it's worth the conversation. But like everything, it's a simple calculation that you need to dive into. And most importantly, know your lock expiration date and build in a buffer. If your lock expires before closing because of an appraisal delay or an underwriting condition, you open yourself up to what are at times hefty lock extension fees, which could end up costing you thousands. The next part of our strategy session that I have for you is to talk about rate buydowns and lender credit options. These are two tools that all home buyers have access to in the mortgage space. To start things off, it's important to understand that when mortgage lenders speak in terms of paying points, all that you are doing by paying points is front-loading some of the interest cost. And by prepaying and front-loading some of that interest cost, the lender is giving you a lower long-term rate. 1 point equals 1% of the loan amount, and that cost is paid upfront and wrapped into your closing costs. In exchange for paying a point, your rate typically drops by only about 0.25. And on a $300,000 loan, you would save around $49 per month. The break-even point would be $3,000 divided by $49 or 61 months, which is about 5 years. If you're confident that you'll stay in the home longer than 5 years, paying points could be a smart move. However, if you might sell the home or refinance before then, you should scratch that idea. Lender credits, on the other hand, are the exact opposite. Instead of paying upfront for a lower rate, you accept a slightly higher rate in exchange for cash towards your closing costs. If you're cash constrained at closing, this can be a valuable tool. And here's a strategy I use with a lot of clients. Stack lender credits with seller concessions. On an FHA loan, the seller can contribute up to 6% of the purchase price toward your closing costs. Combine that with lender credits, and you can dramatically reduce and sometimes eliminate the cash you need to bring to closing. By the way, these are the types of strategies that I go over with every client that I work with. Book a 15-minute discovery call with me to jump into your personal scenario. The booking link is in the description of this video. Okay, now I want to spend a minute or so on refinancing, because if you buy today and when rates do eventually come down, you need to know exactly when it makes financial sense to pull the trigger. The formula to figure out if a refi makes sense is simple. The total cost of refinancing divided by your monthly savings equals your break-even point in months. If you're going to stay in the home longer than that break-even period, refinancing makes sense. Here is a classic refi scenario for you to look at. Let's say you buy at today's 6.5% rate and interest rates drop to 5.5 in a couple years. On a $300,000 loan, that 1% drop in rate saves you about $193 a month. Nationwide, an average refi costs about $4,000 in third-party closing costs, bringing your break-even point to 21 months. If you're planning to stay in the home for 2 or more years past the refi date, that would make refinancing a clear win for you. The second scenario worth diving into is a cash-out refi, which is refinancing and extending your loan amount to put cash in your hands. Common reasons that people execute cash-out refis are for home renovations, debt consolidation, or for funding other investments, among others. The rate on a cash-out refi is slightly higher than a standard rate in term refi, and it resets your amortization clock. Like most decisions, make sure you run the full math before going this route, but it's a powerful tool for homeowners who've built up a sizable amount of equity in their home. And everything comes back around to the same strategy that we talked about earlier. Get the house in your possession now and refi the rate later. Buy today, build equity through payments and home appreciation, and when rates drop meaningfully, we refi. That's how the savvy buyer and investor approaches things. Okay, now we are in the home stretch, and here are the 6 things I want you to walk away with from this episode. Number 1, 6.5% is not historically high. The 50-year average rate is 7.74%. Context matters far more than headlines you see on the news. Number 2 is that the Fed rate is not your mortgage rate. Rates more closely follow Treasury yields. 3, waiting costs real money. Home prices rise when rates fall. The math almost never works out the way people expect when they actually run the numbers. And 4, your credit score is your single biggest player when it comes to your rate. A 620 versus 760 can mean $150 or more per month on the same loan. 5, look to lock your rate as soon as you're under contract and run the break even before you pay for points. And lastly, number 6, and this is the main one I want you to take with you. Marry the house, date the rate. Buy the home you want at today's price, build equity, and then refinance when rates drop. Every generation of American homebuyers has done exactly that. If this episode answered some questions you've had or opened new ones, I'd love to help you take the next step. Book a free call with me. The link is in the description of this video. In about 15 minutes, I'll look at your specific situation, including what your credit score means for your rate, which loan type gets you the best pricing, and whether points make sense for your timeline. No pressure, no pitch, just real numbers for your real situation. Subscribe to Mortgage Story and hit the bell to get a notification when next week's episode drops, where we'll be going deep into how to buy a home with only 3% down and even touch on some 0 down payment loans that most buyers don't even know exist. If you found some value in today's episode, I am going to kindly ask for 2 things. Number 1, please click the thumbs up button below this video and also subscribe to Mortgage Story. It's free, and those 2 clicks will help me grow the channel faster. In closing, every home has a story, and I'm here to help you write it. So from wherever you are tuning in from across the USA, good afternoon, good evening, and good night. My name is Scott, this is Mortgage Story, and I'll see you in the next one.